They do not ring bells when the global financial architecture begins to fracture. They do not send notifications to your phone or broadcast warnings on the nightly news. Instead, the most significant shifts in human history happen in the shadows, characterized by a sudden, chilling silence. Right now, that silence is emanating from the silver desks of the world's largest financial institutions. When 8 of the most powerful banks on the planet quietly shutter their silver trading operations and exit the market, it is not a coincidence. It is a coordinated signal. It is an exit pattern that has been activated. For decades, these institutions were the gatekeepers of precious metals. They controlled the flow, the pricing, and the paper contracts that dictated the perceived value of silver. But recently, we have witnessed a mass exodus. Names like Bank of Nova Scotia, which once operated the legendary Scotia Mocatta, have completely dismantled their physical metal businesses. HSBC, Barclays, and others have significantly scaled back or terminated their silver trading desks. These are not small, struggling local banks. These are the titans that manage trillions of dollars in global wealth. They are the insiders who sit at the table where the rules are written. Why would the architects of the financial system abandon a market they have dominated for over 100 years? The answer lies in the whisper that precedes the scream. In the world of high finance, smart money moves months, sometimes years, before the public realizes the ground beneath them has shifted. Think back to the year 2008. While the average person was being told that the housing market was solid, the major investment banks were already offloading their mortgage-backed securities and repositioning for a collapse. History is repeating itself, but the asset class has changed. The banks see a structural imbalance that the general public is currently ignoring. They see a world where physical silver is becoming increasingly difficult to source, while industrial demand for green energy and high technology is reaching record highs. They see a looming liquidity crisis where the paper promises they have sold for years can no longer be backed by the physical metal in their vaults. By closing their silver desks, they are removing themselves from the blast zone. They are exiting a game that is about to become extremely dangerous for those who are caught unprepared. This video is not about panic. It is about observation. Success in the next decade will belong to the observant, not the loud. It will belong to the men who can look past the headlines and see the patterns of institutional movement. If the largest financial entities are restructuring their exposure to silver, you must ask yourself what they know about the future of the dollar, the stability of the banking system, and the true value of hard assets. We are entering a period of massive wealth redistribution. The gates are closing and the insiders are moving to the exits. The question is, will you stay in the burning building, or will you follow the smart money toward the only thing that has stood the test of 5,000 years of human history, real physical wealth? To understand the magnitude of what is happening, we must look at the specific giants that have stepped out of the ring. This is not a speculative theory, it is a matter of public record, though it was never shouted from the rooftops. One of the most significant departures was the Bank of Nova Scotia, known in the industry as Scotiabank. For over 100 years, their division, Scotia Mocatta, was a titan in the precious metals world, traces of which go back to the year 1671. In the year 2020, they officially shuttered their metals business after failing to find a buyer. Think about that for a moment. A business with 3 centuries of history, a cornerstone of the global silver trade, was simply turned off. But Scotiabank was only the first domino. We have seen similar retrenchment from other major institutions. HSBC, the largest bank in Europe, has significantly reduced its footprint in the London silver market. Barclays and Deutsche Bank have both faced massive regulatory pressure and multi-million-dollar fines for their roles in silver price fixing, leading them to dismantle their dedicated trading desks. Even JP Chase, which remains a dominant player, has shifted its strategy from active market making to massive physical accumulation, holding hundreds of millions of ounces in its vaults while reducing its public trading profile. Other names such as Societe Generale, Standard Chartered, and Mitsui & Company have either fully exited or drastically scaled back their presence in the physical silver space. Why would 8 of the most powerful entities in the world walk away from a market that is essential to global industry? The official reason often cited is regulatory compliance and risk management. Following the financial crisis of 2008 and more recently the implementation of Basel Three regulations, the cost of holding and trading physical assets has skyrocketed. banks are now required to hold much more capital against their precious metals positions. For many, the math no longer works. The profit they make from manipulating paper contracts is being outweighed by the cost of regulatory scrutiny and the physical reality of the metal. However, there is a deeper, more strategic reason for this exodus. The silver market is notoriously small and volatile. The total value of all above-ground silver is a tiny fraction of the gold market, and an even smaller speck compared to the global bond and equity markets. This makes silver a liability for a major bank during times of extreme systemic stress. If the price of silver were to double or triple due to a supply shortage, the banks holding massive short positions on paper would face a catastrophic liquidity event. By closing their desks now, they are effectively washing their hands of a potential systemic explosion. When you look at the numbers, the trend is undeniable. In the year 2024 and leading into 2025, the silver market has faced a structural deficit of over 200 million ounces annually. The banks see the industrial demand from solar panels and electric vehicles rising, while mine production remains stagnant. They know that the old game of using paper contracts to suppress the price is reaching its mathematical limit. They are exiting the trading business because they no longer want to be the ones caught on the wrong side of the trade when the physical reality finally breaks the paper chains. They are moving from being the house that runs the casino to being the private players who own the chips. To predict where the silver market is headed, we must look at the footprints left by the giants in previous cycles. History is a loud teacher, but it only speaks to those who are willing to listen. The current exit of major banks from silver desks mirrors the quiet repositioning that occurred before the 2008 financial collapse. In the years 2006 and 2007, while the mainstream media was still celebrating a never-ending housing boom, the internal memos of Lehman Brothers and Bear Stearns told a different story. The smart money was already moving toward the exits, reducing their exposure to subprime risk, while the public was still being encouraged to buy. The pattern is always the same. Institutional withdrawal precedes public realization. We saw this in the year 1929 as well. In the months leading up to the Great Depression, the most informed investors, including members of the Rockefeller family and Joseph Kennedy, began liquidating their equity positions and moving into cash and gold. They didn't wait for the ticker tape to crash. They observed the imbalance between market prices and economic reality. Today, the banks are looking at a similar imbalance in the silver market. They see a world where global debt has surpassed $300 trillion, while the supply of real, tangible wealth like silver remains finite and increasingly scarce. One of the most powerful historical parallels is the collapse of the London gold pool in the year 1968. For years, a syndicate of 8 central banks attempted to keep the price of gold suppressed at $35 per ounce. They used their massive reserves to flood the market whenever the price tried to rise. However, the physical demand eventually overwhelmed their paper games. One by one, the banks realized they were bleeding physical metal to maintain an artificial price. They abandoned the pool, and shortly after, the price of gold skyrocketed. The closing of silver desks today is the modern equivalent of the banks abandoning the London gold pool. They have realized that the cost of defending an artificial price is becoming too high. This historical echo is a warning. Banks are not emotional, but they are survivalists. When they see a systemic shift coming, they do not try to save the system. They try to save themselves. In the year 1979, during the famous Hunt Brothers silver squeeze, the banks and the regulators changed the rules of the game overnight to protect their interests, moving from a system of trading to a system of liquidation only. The fact that 8 major banks are exiting the silver trading business today suggests they no longer believe they can control the outcome of the next squeeze. They are choosing to step aside before the physical market breaks the paper pricing mechanism entirely. We are currently witnessing what historians will later call the Great Realignment. This is the moment when the financial elite stop betting on the success of the current debt-based system and start positioning for the return of commodity-based value. Every major transfer of wealth in the last 100 years has been preceded by this exact type of institutional movement. The masses wait for a formal announcement while the wise follow the trail of the giants. By studying the year 1929, 1968, and 2008, we can see that the exit of the banks is not an end, but a violent beginning for the next phase of the global economy. To understand why the giants are fleeing, you must understand the greatest illusion in modern finance: the distinction between paper silver and physical silver. In the current global market, the price of silver is not determined by the exchange of actual metal bars. Instead, it is dictated by the massive trading of paper contracts on exchanges like the COMEX in New York and the London Bullion Market Association. Here is the staggering reality. For every single ounce of physical silver that exists in the vaults, there are hundreds of ounces of paper silver being traded. It is a digital shadow that has grown so large it has completely obscured the real object it represents. For decades, banks have used this paper leverage to manage the price. By selling massive amounts of short contracts, promises to deliver silver they do not actually possess, they could create an artificial sense of abundance. This kept the price low and predictable. However, the game is changing. In the year 2021 and 2022, the world witnessed the silver squeeze movement, where thousands of individual investors began demanding physical delivery. This created a nightmare for the banks. When people stop trading digital digits and start asking for their bars, the paper illusion begins to crumble. The banks are closing their silver desks because they no longer want the liability of these paper promises. New regulations, specifically under the Basel Three framework, have reclassified physical gold and silver as Tier 1 assets, but they have placed much stricter requirements on unallocated or paper metal. This means the banks can no longer hide behind a mountain of leverage without holding massive amounts of expensive collateral. They are looking at the math and realizing that the risk of a run on the vaults is higher than it has been in over 50 years. If even 5% of paper silver holders demanded their physical metal tomorrow, the system would face an immediate and total default. We are also seeing a massive shift in where the physical silver is moving. While the paper markets in the West are focused on speculation, the physical markets in the East are focused on accumulation. In the year 2024, we have seen record-breaking withdrawals from the silver vaults in London and New York, with much of that metal moving toward India and China. The banks see this drain of liquidity. They know that once the physical vaults are empty, the paper price will become irrelevant. The real price of silver will be discovered only by those who actually hold the metal in their hands. By exiting the silver trading business, these 8 major banks are essentially saying that they no longer wish to be the lender of last resort for a metal that is running out. They have seen the multi-million-dollar fines handed out to institutions for spoofing and market manipulation, and they have decided that the reward is no longer worth the risk. They are leaving the paper casino because they know the house is about to go bust. For the individual investor, this is the ultimate signal. When the people who print the paper contracts start running for the exits, it is time to stop trusting the paper and start trusting the physical reality. The decision of 8 major banks to abandon their silver desks becomes even more suspicious when you examine the explosive growth in industrial demand. We are currently living through a period of history where silver is no longer just a monetary asset. It has become an indispensable industrial commodity. It is the most electrically conductive, most thermally conductive, and most reflective metal on the periodic table. There is no modern life without silver. And yet, as the world prepares for a massive technological leap, the financial institutions that facilitate its trade are walking away. This is the ultimate paradox of scarcity. Consider the numbers behind the green energy transition. A single solar panel requires approximately 20 grams of silver. In the year 2024, the solar industry alone is projected to consume more than 190 million ounces of silver. By the year 2030, as global governments push for net zero emissions, that number could double. Similarly, the electric vehicle industry is a massive silver sponge. An internal combustion engine car uses about 20 grams of silver, but an electric vehicle requires between 30 and 50 grams for its complex electronics, sensors, and battery management systems. We are moving toward a future where hundreds of millions of ounces of silver are literally being buried in the ground or locked in machines, making them unrecoverable for the monetary market. In the year 2023 and 2024, the global silver market experienced a physical deficit of over 140 million ounces. This was the 3rd consecutive year of massive structural deficits. Mining production is not keeping up. Silver is primarily mined as a byproduct of lead, zinc, and copper. This means that even if the price of silver triples, you cannot simply turn on a new silver mine. You would have to increase the global production of copper and lead, which is dictated by entirely different economic forces. The banks see this supply wall approaching. They know that a massive industrial squeeze is coming, and they do not want to be short on paper when Apple, Tesla, or Samsung come looking for physical delivery to keep their factories running. This creates a monetary squeeze as well. For thousands of years, silver functioned as the money of the people. While gold was for kings and central banks, silver was for daily commerce. Today, that monetary history is colliding with industrial reality. When silver is used in a smartphone or a solar panel, it is used in such small quantities that it is currently not cost-effective to recycle. This means that for the first time in history, we are consuming our monetary reserves. Unlike gold, which is almost entirely recycled and kept in vaults, billions of ounces of silver have been discarded in landfills over the last 50 years. The 8 major banks exiting the market are fully aware of this math. They understand that we are approaching a point of no return, where the available physical silver above ground will be insufficient to meet both investment demand and industrial requirements. By closing their desks, they are avoiding the legal and financial chaos that will erupt when the industrial giants begin outbidding the financial speculators for the remaining physical supply. The banks are choosing to step aside and let the market break. They have seen the data, they have run the models, and they have realized that the era of cheap, manipulated silver is coming to a violent end. The exit of 8 major Western banks from the silver market cannot be viewed in isolation from the massive geopolitical shift currently reshaping the world. While New York and London institutions are shutting down their desks, a new center of gravity is emerging in the East. The nations of the BRICS alliance, Brazil, Russia, India, China, and South Africa, along with their new members, are fundamentally changing the rules of the global financial game. They are moving away from the United States dollar and toward a system backed by tangible, real-world commodities. In this new landscape, silver is not just an industrial metal, it is a strategic asset. China and India have long understood the value of physical silver. In the year 2024, India imported record-breaking amounts of silver, exceeding several thousand tons in just a few months. Meanwhile, the Shanghai Gold Exchange has seen silver premiums consistently higher than those on the London or New York exchanges. This price difference is a massive signal. It shows that the physical demand in the East is so strong that it is pulling the metal out of Western vaults at an accelerating pace. The Western banks closing their desks are watching the physical metal flow from west to east, and they realize they are losing control over the global pricing mechanism. Russia has also made a significant move. In late 2024, the Russian Ministry of Finance announced that it would include silver, along with gold and other precious metals, in its state fund. This is a historic change. For decades, central banks primarily focused only on gold. By officially recognizing silver as a strategic reserve asset, Russia is signaling to the rest of the world that silver is returning to its rightful place in the monetary hierarchy. When nations start stockpiling silver for their national reserves, it creates a floor for the price that no paper manipulation can break. The BRICS alliance is reportedly working on a new trade currency that could be backed by a basket of commodities. If silver is included in this basket, the demand for physical bars will explode overnight. The 8 major banks exiting the market are fully aware of these negotiations. They understand that if they continue to hold massive short positions on silver, they are essentially betting against the collective will of the most populous and resource-rich nations on Earth. They are closing their desks to avoid being the collateral damage in a global currency war where physical assets are the ultimate weapon. This geopolitical realignment marks the end of the unipolar financial world. For the last century, Western banks held the keys to the precious metals markets. But as liquidity dries up in London and New York, and as the physical metal moves to vaults in Shanghai and Dubai, the power of Western institutions to suppress the price is evaporating. The exit of these banks is a strategic retreat. They are abandoning a fortress that is no longer defensible. For the individual observer, this is a clear message. The future of value is moving away from debt-based paper and toward the physical assets that nations are now fighting to control. The most expensive thing you can own in a shifting economy is a reactive mind. Most people spend their lives waiting for permission to act. They wait for a confirmation from the television, a signal from their social circle, or a consensus from the crowd. But as we have seen with the closing of these 8 major silver desks, the giants move in silence. By the time the crowd feels comfortable enough to act, the opportunity has already vanished, and the risk has multiplied. This is the first psychological hurdle of wealth, understanding that clarity is far more valuable than comfort. The wealthy do not seek comfort, they seek an edge. They understand that every major fortune in history was built when things felt uncertain, unstable, and even frightening to the majority. When Warren Buffett famously said to be fearful when others are greedy and greedy when others are fearful, he was not just giving investment advice. He was describing a psychological state of readiness. The banks closing their desks are not panicking. They are positioning. They are clearing the deck so they can move with speed when the real volatility begins. If you are waiting for a headline to tell you that silver is a good investment, you have already lost the advantage of timing. Fear is the tax paid by the unprepared. Think about the small business owner who survived a massive downturn because he kept a cash reserve and avoided debt when everyone else was over-leveraged. He did not have more talent. He had more readiness. In the silver market, the unprepared are those who believe the paper price on their screen is the ultimate truth. The prepared are those who look at the institutional exodus and realize that the paper price is a lie designed to keep the masses away from the exit until the giants have safely passed through. To move from a consumer mindset to a strategic mindset, you must train your mind to see patterns instead of noise. Noise is the daily fluctuation of the silver price by 50 cents. A pattern is 8 of the world's largest banks closing their trading operations simultaneously while global industrial demand reaches an all-time high. When you see a pattern this large, your response should not be emotional. You should not ask if you are scared. You should ask if you are positioned. Strategic patience means being willing to hold a position that is unpopular for as long as the underlying logic remains sound. This mindset shift extends beyond your portfolio and into your identity as a man. A leader is someone who prepares his household before the storm arrives. He does not wait for the rain to start before he fixes the roof. The movement of the banks is the first drop of rain. Most people will ignore it, hoping for the sun to return. But the ready individual recognizes that the climate has changed permanently. You must decide today if you are going to be a victim of the coming wealth transfer or a beneficiary of it. That decision starts with the discipline to trust your observation over your emotions. There is a common misconception that wealth is destroyed during a financial crisis. In reality, wealth is rarely destroyed. It is simply redistributed. It flows from the hands of the many who are distracted, emotional, and over-leveraged into the hands of the few who are focused, calm, and liquid. When 8 major banks close their silver desks, they are not deleting wealth. They are anticipating a massive tectonic shift in where value is stored. They are preparing for a moment when the artificial value of paper assets collapses and the true value of real tangible assets like silver is reasserted. This process of redistribution follows a predictable cycle. In the first phase, there is an era of artificial abundance, where low interest rates and massive debt allow everyone to feel wealthy on paper. This is the phase of peak comfort. In the second phase, structural imbalances begin to appear. We see this today with the physical silver deficit, the rise of the BRICS nations, and the institutional exit from the paper markets. The third phase is the realization phase, where the public suddenly discovers that the paper promises they hold cannot be converted into the physical reality they expect. This is when the wealth transfer accelerates. Consider what happened during the Great Depression. While the average citizen lost everything in the stock market crash, those who held physical gold saw their purchasing power increase by over 40% almost overnight when the government revalued the metal. Similarly, in the year 2008, while the masses were losing their homes to foreclosure, private equity firms and well-capitalized investors were waiting with billions of dollars in cash to buy those same assets for pennies on the dollar. The banks closing their silver desks are positioning themselves to be the buyers, not the victims, in the next great realignment. Liquid assets and real assets are the 2 keys to surviving a wealth transfer. Liquidity gives you the power to act when others are frozen by fear. Real assets like physical silver protect your purchasing power when the currency is being devalued by central bank printing. Silver is unique because it is currently one of the most undervalued assets on the planet relative to the amount of currency in circulation. In the year 1980, the silver price reached $50 per ounce. If you adjust that for the inflation of the last 45 years, silver would need to be in the hundreds of dollars just to match its previous peak. The exit pattern we are witnessing is a sign that the gatekeepers are leaving the burning building of the paper-silver market. They are moving their capital into positions that will benefit from the inevitable repricing of the physical world. For you, The opportunity is to move alongside them before the doors are locked. Wealth redistribution does not ask for permission, and it does not care about fairness. It only rewards readiness. By understanding that silver is currently being transferred from Western bank vaults into Eastern national reserves and private hands, you can see exactly where the future of wealth is being built. Understanding the exit of major banks is only valuable if it leads to a change in your personal strategy. Information without execution is merely entertainment. To survive and thrive during this systemic shift, you must move from being a spectator to being a strategically positioned participant. This positioning is built on three unbreakable pillars: diversifying your income streams, owning real and productive assets, and committing to continuous macro education. These are the tools that allow you to navigate the same waters as the giants, but with the agility of an individual. The first pillar is the rejection of single-source dependency. In an era where 8 major banks are restructuring their core businesses, you cannot afford to rely on a single paycheck or a single investment. Diversified income means building multiple channels of cash flow that are not all tied to the same economic sector. This might involve side businesses, digital assets, or rental income. The goal is resilience. When one system experiences a shock, your other channels provide the liquidity necessary to stay calm and opportunistic. The second pillar is the aggressive accumulation of real assets. This is the direct answer to the banks closing their silver desks. If the institutions are exiting the paper market, you should be entering the physical market. Physical silver, held in your own possession or in high security, non-bank private vaults, represents wealth that has no counterparty risk. It cannot be deleted by a bank failure or neutralized by a digital glitch. But strategic positioning goes beyond just buying metal. It involves owning productive land, shares in essential businesses, and commodities that the world cannot function without. You are looking for assets that will retain their utility regardless of the value of the dollar. The third pillar is continuous learning. The world is changing too fast for static knowledge. You must become a student of macro trends, understanding how the BRICS realignment, central bank digital currencies, and industrial supply chains impact your personal economy. Read the reports that others ignore. Track the movement of institutional capital instead of the noise of social media influencers. When you understand the why behind market movements, you no longer need someone to tell you what to do. You develop the financial muscles to make your own decisions. Action must be taken with discipline and timing. Do not chase the price when silver is making headlines. Position yourself when it is quiet. Start by building a base of physical metal that represents a meaningful percentage of your net worth. Then, focus on eliminating high-interest debt that makes you a slave to the very banks that are currently repositioning themselves. Finally, invest in your own ability to generate value in a new economy. The banks are closing their desks because they are moving toward a new financial era. By following these three pillars, you are making sure that when that era arrives, you are standing on solid ground while the rest of the world is still trying to find its footing. The future is not a mystery to be feared, it is a structure to be understood. Throughout this analysis, we have seen that the movement of 8 major banks exiting the silver market is not a random event. It is a loud institutional whisper that the old world of paper leverage and price suppression is coming to an end. The titans have seen the industrial deficits, they have recognized the geopolitical shift toward the east, and they have calculated the risks of a broken system. They have made their move. Now the responsibility of movement falls to you. History has shown us time and again that the transition from one financial era to another is never announced by a trumpet blast. It happens quietly in the fine print of bank reports and the restructuring of trading desks. Those who wait for the world to agree with them before they act are usually the ones who pay for the success of those who moved early. Wealth is not just about having money, it is about having the foresight to be in the right place before the crowd arrives. It is about the discipline to prepare in the silence so that you can remain steady when the world begins to scream. As a man in this complex modern economy, your primary duty is to be the observer for your family and your future. You must look past the distractions of daily politics and social media drama to focus on the structural reality of the world. The banks have shown you the exit pattern. They have abandoned the paper game because they know that the physical world is reasserting its dominance. By diversifying your income, securing real assets, and training your mind to see these patterns, you are not just surviving. You are designing a life of true independence and control. The next decade will be defined by the great realignment of wealth. It will be a time of extreme volatility for the unprepared, but a time of unprecedented opportunity for the ready. The gates are still open, but they are closing fast. Do not be the one who looks back 5 years from now and says you saw the signs but failed to act. Be the one who recognized the signal, trusted the data, and positioned yourself for the inevitable. The future does not belong to the lucky, and it certainly does not belong to the loud. It belongs to the observant. If this deep dive into the global silver markets and institutional behavior has given you a new perspective, then you are already ahead of the majority. Take the first step today. Study the history, audit your assets, and begin moving your capital into things that are real. Like this video if you value logic over emotion, and subscribe to join a community of men who are serious about building a foundation that lasts. The whisper has already begun. The only question left is, are you listening? Thank you for watching, and stay focused on the path ahead.